Okay, well, hello, everybody. Welcome to the Taxes and Accounting Housing Workshop. Glad you made it. I'm Stacy Sanders with Housing Oregon, and I'm the Director of Policy and Advocacy. We're joined by Jones and Roth, the esteemed panel. We have Fritz, Duncan, and Kari Young, who for the next hour will enlighten us about taxes and accounting for affordable housing, the essential updates for 2021. Feel free to submit your questions in the chat room and we will be able to respond accordingly. All right, enjoy.
All right, well, we'll just go jump into it. So I'm Fritz Duncan. I'm a partner here at Jones and Roth. I think I had my 30th tax season, this last tax season, so I've been doing it quite a long time. I actually got involved in the industry way back in 1992. One of the Lane County developers built their very first LifeTech project way back then, and I got involved and I just loved it. And so I've been involved in it ever since. And so this is one of my specialties is affordable housing and also nonprofits. I'll let Kari go ahead and introduce herself and we'll get going.
Hi, everybody. I'm Kari Young. I'm a partner and shareholder with Jones and Roth as well. And I work closely with Fritz and the rest of our affordable housing team to serve clients across the state and the Pacific Northwest. And just like Fritz, I work a lot with our affordable housing clients as well as our nonprofit clients. And we're happy to be here with you guys today. So I'm going to go ahead and share PowerPoint we have. And like Stacy said, if you have questions along the way, please feel free to put those in the chat box and we will do our best to answer them as we go or at the end as time allows. So first, I want to start off just by sharing a little bit with you all about Jones and Roth. So Jones and Roth is one of the largest firms that is headquartered in Oregon. We have 3 offices across the state to serve our clients. Our team members are experienced and we have 13 specialized teams within our firm, including specialized teams for affordable housing and nonprofits. Our affordable housing team provides a wide range of specialized services designed to navigate the complexities of the affordable housing space and help you succeed. Additionally, our nonprofit team, which is one of the largest in our firm, works with clients across the state to provide audit, tax, and consulting services. And we're really happy to be here with you all this morning virtually to support the Housing Oregon Conference. So today our plan is to hit some of the key kind of hot topic or our most important things we think are important to discuss with you all. That's going to include going through the IRS Form 8609. Fritz is going to talk about the basics and complexities of Lease Up. We will talk through the importance of tracking your tax basis, how to navigate and apply the Cashflow Waterfall from your partnership agreement. And lastly, I'll provide an overview of the Oregon Corporate Activity Tax. So Fritz, if you want to go ahead and start us off, we'll get going.
Okay. If you want to, I guess, go to the next slide. So really quickly, so we thought this would be a good topic. We just finished the 9/15 deadline for all the partnerships. We had a lot of new projects with 8609s, a lot of things that came up over the last year. So we thought we'd go through, hit the highlights, talk about some things that came up. Just the 8609 itself, this is just a form, you know, it gets issued by the states. You actually get your credit. So you've all probably all seen that before, but there's this form. And if you want to go to the next thing, just a couple things that came up during this year were some timing things to consider. So first of all, you're going to apply for your credits. You're going to turn in your application with the cost cert, and you have to keep in mind how long that takes. So if it takes 2 to 3 months for them to go through your application and issue a draft 8609, you want to keep that in mind. And you also want to keep in mind the Part 2 completion, and we'll go in the form here in just a second. But the Part 2 completion, really quickly, our preference is when you finish Part 2 and you're going to submit your tax return, you're going to submit those, you want to make sure everybody's signed off and approved them before you send them into the state. What we saw was the state this year, they'll ask, for example, they issue them to you in May and they want you to give them back to them, but you shouldn't do that until you finish your tax return. And so if you just, for example, you just tell the state, hey, we're still working on the tax return. When that's done, we'll turn these back in. But you want to keep in mind that once those are turned into the IRS, those are irrevocable. So you just want to keep that in mind when you're talking about timing. But just the form itself, so some key things here, and then we'll look at the form. So obviously the biggest thing on there is the credit. When you get your 8609s, it's important to literally add up the credits and make sure it adds up to what you expected. It's pretty rare that you see any mistakes there. You know, the state's doing the same thing where they've got your credits, they're getting allocated per building, but that number, I've rarely ever seen any errors in there, but you want to add them up just to make sure that it all adds up to the exact dollar that you're expecting. That second line 2 is the credit rate. Again, I've never seen errors in the rate, but basically you're proofreading this when you get this draft from the state, you're proofreading this for anything you have questions on. 3A is the basis. And then just to point out for this, for acquisition, that's generally not your actual basis, but it's the basis to get the credit. So 3A may not match your final basis for a new construction project. If you're doing an acquisition rehab, it's likely your actual basis you had, but that's where each building, that's the eligible basis that you've spent. That will be on line 3A. Another thing to keep in mind is line 4. If you're doing a 4% project with a municipal bond, you have to meet a 50% test. That's where they put in the actual percent. You have to meet it. You have to have the 50% test. You have to actually meet the 50% or more amount. So just be aware of that. But line 5, I wanted to bring up the date placed in service. That varies depending on what this form is for. So for new construction, that's likely the certificate of occupancy. If it's AC rehab, you could have a date for the date you bought the building. You could have a date for when you finish your rehab, but you want to check those dates. Because for example, you may turn in your application, you might turn in some dates. You want to make sure that's the date that you are expecting to start credits. For example, but if they put November on there, but you thought you were going to start taking credits in October, you need to talk through what the correct date is, because that's going to drive what credits you're going to take. So that line 5 is really important. Check that date. I've seen that sometimes in acquisition rehab where you have to work through updating those dates and just talk through it with the state. But they'll of course usually go through with you and update that if it needs to be. Let's see. Sorry, I skipped over. Sorry, Kari, go back. I skipped over the other part there on 3. The 3B, the difficult to develop. So it used to be that would be 100 or 130%. Those are your two options. But in the last few years, the states have been limiting that percent markup to what you actually need. So they don't just give you 130% of your costs anymore. Whatever your costs are, they will limit that. So if you only need 108%, that will say 108%. So you no longer get to mark your costs up all the way up to 130% if you don't need it to get your credits. If you need all the 130%, you can use it to get your credits, but they will limit that. And that's been a change the last couple of years. Let's see. I think those are all the keys for that. So part 2 again, and then you can go and go to the slide, Kari. I've got the line items here. So if you looked at the top part of this line 7 and 8, that's your actual basis. For you think about the actual eligible basis you had, that should go on those lines. So that number could be higher than what's on the line above. It's possible that whatever you spend is higher than what was on the cost cert, or maybe what you needed to get the credits. But this is what you actually spent. But line 8B is a critical line. Most projects we see check the box saying, I want to treat this building as a multiple building project. If you do that, you get to do compliance for the whole project. If you don't do that, each building is its own compliance building, which could cause problems for you. So most people check 8B yes. And then one of the takeaways is you have to attach a list to the 8609s of who you're including in this project. So some people say, well, it's all the 8609s. The IRS doesn't care. They want a list when you turn this into them. And if you don't attach the list, technically your returns are not sent in on time and they're deficient. So you want to have that list in there. Your CPA is going to work with you on actually getting all this put together. Let's see. Another key there is on 10A. For any of you, you're finishing your project, you have to decide, if I finish in 19, for example, versus 2020, I need to decide if I'm going to defer. So if the building was finished in 2019, you can decide to defer the credits to start in 2020 or start taking them in 2019. That box is critical that you do that right, because again, this form is irrevocable. If you turn this in, you cannot change your mind. So that you want to be really, really careful when you check that box. And then the other one down there on 10C, the set-asides, you have to be really careful what box you check here. Most people check 40/60. The projects are 60% income. That's what most of the ones we see. You can see there's the new one in there for average income. That's a whole nother class for a whole nother day, but you can use average income now. But again, when you're turning these in, make sure you check that right. Way back at the beginning of my career, my previous firm, they had checked 20/50 instead of 40/60. They meant to check 40/60. They were in big trouble because their income was 60%. It was not 50%. So they had to go back and get a private letter ruling to get that fixed. So be really careful when you're filling this out. And again, we can't stress, you want to go through this with you and your CPA and your limited partner, make sure everybody agrees. And then after you've done the tax return, then you turn these into the IRS, of course, give a copy to the state. So I don't care if you saw any questions on that.
No questions so far, but please feel free to put those in the chat box.
Okay, so some highlights of Lease Up we've seen this year. I think this comes up quite often. So just the basics of Lease Up. The reason why this is an issue is you have to follow these rules to get your first year credits, and they vary between new construction, ACK rehab, but you have to be aware of how those are calculated, and we're going to go through that here. I think the one takeaway from this slide is when you put a building in service, that starts to clock and it's the next full month. So for example, if the building is put in service on March 15th, it is April that you get your first credit if you've leased up the units any day in April. So you have to be really careful about that. If you're expecting to get March credits, you can't put the building in service on March 15th. It has to be March 1st. So that's a key. You have to be careful when you're doing your whole lease up that I'm aware of the dates I expected. So these couple of slides are they're just summarizing all these things. And again, they change between acquisition, rehab versus new construction. This is talking about new construction, but just be aware of the rules and your plan. So when you did your project, you had a plan for when you get your first year credits. And so when you're filling up the buildings, you want to be aware of the plan. So if you have multiple buildings, you have to be really careful when you're leasing them up and you're going to start taking credits. Let's see. And then, so this just says, make sure the property manager, the contractor, everybody's aware of the plan because your first year credits are going to be based on when you get all the buildings put in service and then leased up. Let's see. Trying to see anything else on here. No, I think you can.
Fritz, do you want to address the importance of considering leasing up one building at a time?
Right. So if you picture it again, let's say you have 10 buildings, you get your credits based on every unit in the building for each building, and all those buildings, they have to be in place by year end. So one at a time has to be in place for you to take credits without getting a penalty. So for example, let's say you have a building that you're going to defer into the next year. That's okay. You're not going to get credits on that one. But for example, of your 10 buildings, let's say that you had 8 buildings and each of them were missing 1 unit, then you'd have to defer all 8 buildings. I mean, that would be a possibility. So just be aware of when you're doing this, it's by unit and by building, and all the buildings have to be in place by 12/31 to take the credit without any penalty. So just be aware of that. Go ahead, Kari. I just put a slide here in the middle, just a couple of quick things to be aware. We just talked about the December 31 lease up rules. Everything you do during the year, it doesn't matter the day you put the units in service and the day they're leased up, as long as they're leased up by 12/31, you're going to take credits in that year. If you cross 12/31, you have 2 choices. You can defer the building, or you can have this thing called the 2/3 rule, which I'm sure some of you heard of. The 2/3 rule is I'm going to put the building, I'm going to start taking credits, but I'm going to be penalized on the units that I'm adding after 12/31, and I'm only going to get 2/3 of those credits every year instead of the whole thing. So it's called the 2/3 rule. And really what you're doing is you're losing credits from year 1 to 10. You're getting them from 11 to 15. Your partner will likely penalize you for that because they wanted the credits earlier. A lot of partners don't give you credit. They don't give you credit for credits that happen after year 10 because that wasn't the plan. So just be aware of that rule. And again, you can talk to your CPA about if you have something like that, it might be that you need to use that rule, but just be aware what that's going to mean to your credit stream. Like that. What am I doing? Let's see. So a lot of these are just takeaways. I haven't seen this very often, but one of the comments we had from these prior years was be careful about when you're doing your tenant certifications, if it's a long project. So if the project gets delayed, I don't remember the number of days you have when you have a certification, but that's happened before where they did these way early in the process. The project gets delayed and they've got a problem, they have to recertify the person, but just be aware of starting too early. I'm not sure how often that happens. Let's see. I think one of our lease up stories is we've had that happen where someone had a tower, so I don't know, 40 or 50 units, and they didn't do the lease up correctly and had to defer the whole tower because again, it's a building by building thing. If you have a tower, if not every single unit is in there at 12/31, you have to either defer or have the 2/3 rule. So they had to defer the whole tower, which is not great. Let's see, got that. Acquisition rehab is a little bit different than new construction. So you buy a building, you certify the people. Technically, they're now certified. The day they're certified, they're now certified. You're working on the rehab. You finish the rehab. What you're what you're allowed to do is the sorry, I got distracted there. So let's see, you're allowed to take the credits back. So for example, if I bought the building on 1/1 and I finished my rehab during the year, you're allowed to have the credits start on 1/1 if all the units were qualified as of 1/1 and you finish the project by the end of the year. One of the exceptions to that is on when you have relocating people out of their buildings, you got to be careful if you're relocating people while you're working on the building, how that's going to affect the tax credit calculation. One takeaway there at the bottom, you'll likely have 2 dates on your 8609s. You'll have one 8609 for acquisition cost. You'll have one for rehab. Acquisition date, it should be acquisition date, but then the rehab date is based on when you finish spending the money. That's the date you pick. But those are usually 2 different dates, and a lot of times they're in 2 different years. So just be aware of that. We just had a project that had 37 buildings, acquisition rehab, 74 8609s. It's the biggest I'd ever seen, $100 million project. They usually aren't that complicated, but so that was a big one. Okay, let's see. Anything else on there, Kari? So some of this just, again, just at the end here, just be aware of your plan. What's the LPA agreement say? We did have one thing, that the pitfall, be really careful. If you finish your units and you put them into service by 12/31, you could be finishing costs after 12/31. Like for example, landscaping, things outside the building, you can do that, but now you've crossed the year. If you want to take the credits as of 12/31, all the costs have to have been expended. So one thing we saw happen was they knew they got the units in place by 12/31, but they went and spent the rest of the money after 12/31. They had to defer the building into that next year because they didn't get all the costs by 12/31. They had to date it, for example, this is March 31, but it's March 31 in the new year. We've seen some inefficient lease ups, like Kari was talking at the different buildings. We've seen people, put units in every single building and not lease up one building at a time. So just be aware of you got to have the whole building done by the end of the year. I think those are all the things we had for that.
I don't see any questions about this up in the chat box.
Sorry, I can't hear you, Kari.
Still can't hear me?
What?
I don't see any questions in the chat box about Lease Up, but if anybody has any, feel free to throw those in there.
Okay. So third topic, another thing that comes up quite often is tax basis. That's not your responsibility to know how to do tax basis, but you want to make sure your accountant is doing it, you're aware of it. So some things we wanted to talk about. They should be tracking your basis from year one. I think in the old days, there are some times where people didn't start tracking your basis because it didn't matter. And so maybe the accountant didn't track it, but that led into problems later. It's better from now on if you just do your tax basis as a year one. And now on the new tax returns, it actually goes on the tax return. So that's kind of alleviated that problem that you have to do that. A lot of people did tax basis on the tax returns, but you could use GAAP in the past. Can't do that any longer. But you want to be tracking your tax basis, and not only tracking it, but we talk about here, and we'll show you an example, we want to be projecting out our tax basis. Because if you pictured year 1 through 10, you're taking your credits, you must have limited partner, must have tax basis to take those credits and losses through the credits. If they run out of basis after year 10 or 11, that's okay. You could have losses being reallocated, but you got to be really careful if you're projecting out your tax basis and they're going to run out of basis before year 10, because if you don't do something, and we're going to talk about that here in a second, you could have problems with your credits. If you want to go, Kari, this is just your K1, this partner, this limited partner. After this year, they had $6.1 million of tax basis. So you can see they have plenty. If this is year 2 or even year 10, hey, this is awesome. They have plenty of tax basis. But this is just what it looks like on the tax return. And then here's just an example of the schedule that we do. It's just Excel. But we're basically taking the limited partner now, because the K1 are all on tax basis. You have one for both the general partner and the limited partner. General partner basis is not usually an issue, but this is normally with always the limited partner. You can see all they're doing is they're saying, what's my book capital? What's my tax? And so they've been calculating. So at 2020 in year 8, they had $1.5 million of tax basis. So they've got plenty. You're not, even though that's going to be close, you're looking at this saying, when I project out of it, how much basis will I have? But this is an example of how you do it. And then here's the projection we have. So it's year 8. We know our actual tax basis is $1.5 million. The last year had almost a $900,000 loss. So for year 8 through 15, we plug $900,000 in there to be conservative. And then we say, do I see any problems coming? In this case, yes. In year 10, I went negative. And if the credits, the credits, of course, are either year 10 or year 11, this particular project, this would be a problem if you did not have minimum gain. Talk about that in a second. But if you did minimum gain and they've got this negative tax basis, then they're going to have a problem. So you want to project this out and be aware of it and try and do something about it if it's going to come up, and plan. Let's see. So really quick, this class is only an hour long. When you're talking about tax basis, there's a term called minimum gain. Minimum gain is just a tax thing that they made up. And they basically, there's this calculation saying, I want you to take your qualified debt, your mortgage mostly, and if the mortgage is bigger than the basis in your property, that would be a gain if you liquidated. And so if there's a gain, the IRS allows you to take losses against that. So this thing called minimum gain. You want to be aware of this. And so, for example, you start your property, you can probably easily check and say, am I going to have any minimum gain? A lot of properties do not, some do. And so, for example, if I'm going to run out of basis, am I going to have minimum gain that'll help me if I need it? And so if you go to the next slide, this is a calculation. So look there in the middle, line 4 and 5, those are the key, 2 of the keys. You literally take your non-recourse debt plus interest, $15.5 million, their tax basis plus the replacement reserve, $14.8 million. Their minimum gain is $680,000. So technically, they can take their share, limited partner, of $680,000. You can take that against losses. So if you look at this example, their capital account was only $200,000 negative at the end of the year. And since they had minimum gain, it wouldn't go negative and they wouldn't have to reallocate credits and losses. And again, a lot of you have probably seen this before. Like in a lot of these examples, the credits are $500,000 a year, $1 million a year, whatever the number is, it's a big number. If you don't have tax basis and those credits get reallocated, the limited partner loses them, they will not be happy, and you will get, the partnership and probably the general partner will get penalized. And so you want to be aware of the basis, the minimum gain, and am I going to have to do something? So this is minimum gain. And then, so one last thing here before we go on to the Kari subjects. So let's say I run out of tax basis, I have no minimum gain. What do I do now? If it happens for year 10, I would say most people, they decide that they must do something because they can't afford, nobody wants to reallocate the credits or the losses. So there's a couple things you can do. If you pictured your income statement for book and for tax, it has a loss, let's say it's a $500,000 loss. What can you do to wipe out the loss? And what a lot of people end up doing, and again, this doesn't happen very often, they can forgive their general partner debt, they can forgive liabilities that are not the mortgage that they control. And they, in forgiving that, that's income, and they basically wipe out the loss and have, they break even for the year. The bad thing is you're writing off maybe general partner debt, but the good part is you're not losing any credits or losses. And again, you don't want, the limited partner's not going to penalize you. So we've seen that happen often. You can suspend some other, for example, partnership fees. You can do that. That doesn't happen very often. The biggest thing we see is general partner debt. And usually you've got quite a bit of it in these partnerships where people will forgive that until they get to year 10. And then after year 10, you don't have to do that. Once you're past the credit period, again, which is usually year 11, a lot of people will just let the loss be allocated, and then everybody's happy as long as the credits have been, and the capital account, all the losses have been taken. So that's a crash course on tax basis and minimum gain. I think we had just one more example there. And this is just an example. It looks like they think they had a $300,000 negative tax capital in 2022. When they got to 2022, what did they do? They forgave $300,000 of debt. And so they had no, like when you pictured your tax return, you basically have either a little bit of profit or zero. You wouldn't have any loss at all. And that way the losses and credits won't be reallocated. So, and again, you gotta be careful. People think of year 10 being the critical one, but a lot of times you have credits in year 11. So this rule applies through the whole year of credit. So if you're taking credits in that year, you can't run out of tax basis. All right.
Does anybody have any questions? We're happy to answer them if you want to put them into the chat. Went through 3 of our 5 topics, so please go ahead and throw those questions in there. So next I'm going to go through the cash flow waterfall or cash flow priority payments that you all are probably familiar with from your partnership and operating agreements. So we've broken this down into kind of 4 steps that we think are important for you all to be aware of when you're starting a new partnership, or just on an annual basis, reminding yourselves of what key items apply to each partnership. Because as you probably know, each partnership agreement is a little different. Each cash flow waterfall is written a little differently. So it's really important to have a good method to make sure you're reviewing these and keeping track of the cash flow waterfalls for each of your different projects. So this 4-step process starts with making sure you review the agreement that's typically in the partnership or operating agreement, and reviewing for important definitions that feed into the calculation of available cash flow. So these are usually in an exhibit or in the definition section, and it's really important to go through and find each key word or phrase and look at those definitions to make sure you're going to be able to properly calculate what's considered available or excess cash flow. Some of the things I typically see are uses of terms like gross receipts or gross revenue, and you want to make sure you know what things are in that revenue number, because there might be certain items that are excluded. Also, they tend to use things like operating expenditures, but then when you go look at the definition, it includes things that we don't typically think of as an expense for accounting. It'll include things like reserve deposits, which aren't an expense on accounting. So it's important to go read through all those definitions, gather all that data. The second step is then to go look at the actual cash flow waterfall or cash flow priority payment schedule. That is typically, I usually see it in an exhibit to the partnership or operating agreement. So you want to make sure to have that flagged for each of the partnerships so you can refer to it on an annual basis so you know what you're actually looking through as you apply the waterfall. So of course, third is to review those, and you're going to follow that as you pay items. The fourth step is actually doing the calculation and making sure that you indeed have available cash flow before you make any payments on any fees or debt payments that are subject to the partnership having excess or available cash flow. We suggest that you have an Excel workbook set up for each partnership or each project you're working with. Probably have like a tab for each year and be tracking your calculation and making sure you're doing that at least annually. Ideally, what I recommend to my clients is that you're doing kind of a preliminary calculation after you've done your preliminary close of the year-end books. And then you're revising that after you've gone through the audit process, if there were any adjustments or anything, and getting that final cash flow number that then you can use to make payments for that next fiscal year. Also, when you're going through and looking at all the agreements and definitions, it's important to keep in mind that there might be other agreements outside of the partnership agreement or operating agreement that have restrictions on how you can pay out cash flow. And so you always want to use the most restrictive definition or the most restrictive calculation, so you're not violating any other regulations of it or covenants of any of your other agreements. So make sure you're keeping an eye out in multiple agreements there. So next we're going to go through an example. So here's an example of kind of some common language that you might see in your partnership agreements for cash flow. So in this example, the calculation says that cash flow is based on all gross revenue collected from normal operations over project expenses. So if I were to see something like that, I would say, okay, I need to know what gross revenue means. I need to know what normal operations means. And then I need to know what project expenses mean, because those could probably have different meanings depending on who's looking at the words. So if you can't find definitions, then I would make sure just to document what you're considering as gross revenue or what you're considering as normal operations. Hopefully there's good definitions so you can be sure to follow it to the letter. But if not, in the absence of actual definitions, go ahead and just make sure you're documenting what you're interpreting those to mean. Typically, project expenses include amounts that are all operating type cash expenses, and then they'll have things that you're adding back as non-operating. Those are usually defined. Typically, all of your cash flow contingent fees are not considered in that project expense number, so you're adding it back. You're also adding back items that are non-cash, like your depreciation and amortization expense. However, typically it also includes items that we don't typically consider expenses. Like I mentioned earlier, oftentimes there's requirement to fund the replacement reserve and potentially make other non-cash flow contingent payments first. Oftentimes project expenses includes principal payments of debt, which isn't an expense. So that's why it's really important to go look at that definition before you move forward in actually doing the calculation. So in our example, this is what your cash flow waterfall or priority payment listing looks like. So the agreement outlines that first we pay any credit deficiencies to the limited partner. We pay the limited partner for any federal taxes from taxable income. These are typical things I see at the top of the waterfall. However, most of the time they're not applicable. So you just say, I don't have that, skip through it. In this example, the third item is to pay the investor service fee to the limited partner. That's a common cash flow contingent item, either called investor service fee or asset management fee. Next, it says to make sure the operating reserve is funded to a certain threshold. then you get to pay some of your developer fee. And then once that is paid, then it lets you start paying your general partner fee. So again, this is just an example here. So let's do the calculation. So if we look at our accrual basis GAAP financial statements, and we have a net loss of $429,000, based on the definitions we're seeing in our agreement, we would add back depreciation because that's a non-cash expense. We're going to add back the investor service fee, and that's not because it's not an expense. It is an expense. However, since it's cash flow contingent, we have to add it back to get the available cash flow number. So we add that back, and then we're going to deduct our required replacement reserve deposits for the year. And again, that's not an actual expense. That's of course just a deposit to your asset account. But for purposes of this calculation, it comes out of your available cash, and then also any principal payments. Usually this is only on your first mortgage or primary debt that you're backing out. It would include any principal payments on cash flow contingent debt. So that leads us to have $38,240 of available cash flow. So that's our actual available cash that comes over, and we take that to the cash flow waterfall. So you start with that number, and I encourage you to go through each step and document how you're applying that cash flow to that step. And if there isn't any, like there isn't anything for step 1 and 2 here, you just document there's none. Show what you're paying for investor service fee. Next would be if your operating reserve was underfunded. In this case, we're saying it was fully funded. So then I have $26,240 left to pay against my deferred development fee. And you only pay, of course, the amount up to your available cash. So this is a pretty basic example, but the key takeaways here are to carefully review your partnership agreement for key definitions, as well as the actual waterfall priority schedule, and keep documentation of where that lives. Calculate available cash before you make any cash flow contingent payments. Calculate that cash flow at least annually, ideally once at the preliminary close, and again, checking it after you've done your final close and audit. And then lastly, keep documentation of the calculation and the available cash flow payments made for reference. Any questions on that? Don't see any questions. All right. So we're going to move on to our last schedule topic, which is the Oregon Corporate Activity Tax, or we just call it Oregon CAT for short. And this is, not a new thing because it was effective January 1st, 2020, but I figured based on what we saw for our tax season that it wouldn't hurt to go through this again, make sure everybody's aware of the rules and the steps to make sure you're registered and when you have to make payments and when you have to make estimated payments. So to start, an overview of the Oregon CAT. It's a modified gross receipts tax. It's not an income tax. It's also important to know this is at the entity level. So it is the partnership paying the tax. It doesn't get passed through to the partners on their Schedule K-1. It's based on Oregon commercial activity. So if you have an entity that has nexus in other states, then there's an apportionment that happens. The proceeds from the Oregon CAT are basically for a student success fund. So they kind of marketed it as a student success tax. And so that kind of confused some of my clients last year. They're like, wait, is this the Oregon CAT or is this another tax? So it is the same thing. And as I mentioned, it was applicable to the 2020 tax year. So starting on January 1st, 2020. So in a week on the 15th of October, all your Oregon CAT tax returns are due. And your payments should have already been made initially with the due date, which we'll talk through here in a second. All right, so here's a big picture overview, and this is a nice thing to reference later. So you want to, for each of the commercial activities, so if your commercial activity, Oregon commercial activity is below $750,000, then you're completely excluded from having to do anything. And that's on an annual basis. So if you have a partnership that perhaps is kind of teetering around that $750,000 threshold of revenue, you want to be sure to monitor that. So if you're below that number, you don't have to do anything. if you're at $750,000 of commercial activity or above, then you have to register with the state, and we'll go through that registration process. However, it's not until you reach $1 million of organ activity that you actually have to file a tax return. So there's certainly, there's a whole span of people that might have to register, but not actually have to file a return, which is kind of unique with this organ cap. And then it's only after, if you have over $1 million after subtractions, that you actually would pay any organ tax. So this leads you to the question probably, well, what's commercial activity? So it's only applicable to organ commercial activity. And this is based on if you have advantages because of organ's economy. It doesn't require physical presence. However, for rental properties, it's pretty easy because your rental property, if it's in the state of Oregon, then it is subject to organ cap. I won't go through all the other details of Nexus since it's not probably applicable to most of you. Commercial activity excludes certain things. So they didn't necessarily say everything it does include, but they did lay out some things that excludes. And there's a list of over 40 things that are excluded. I included the top 15 here. Some that are going to be applicable to probably most of you are interest income and any dividend income. That's excluded from being considered commercial activity. Proceeds from the sale of any business property is also excluded. So if you sell some assets off, that's not going to be part of your gross receipts for this purpose. Also, if you have any damages from litigation, so if you have a lawsuit, you receive proceeds from that, that is not subject to being included in commercial activity. There's a few kind of random carve outs, or maybe not random, but result of probably lobbying and other things. But specifically, grocery sales are not included, motor fuel is not included. There's some other items here that are specifically excluded from commercial activity. So good, it's not an all inclusive list, but kind of that top 15 most common items there. All right, the next question we have to answer to figure out how all this works is, who does this apply to? So we figured out what corporate activity is. Now, who are applicable taxpayers? So generally it includes all individuals and entities that have organ commercial activity. And this includes disregarded entities unless they're specifically excluded. When this all first happened, this raised some questions for some of my nonprofit clients that had disregarded entities. And the question was, well, is the income in my disregarded entity going to be subject to this tax? And after some research and consultation with the state, they said if you have a disregarded entity that is wholly owned by a tax-exempt entity, then that related income would not be subject to tax. It would only be any unrelated business income that exceeded these thresholds. So this is the full on long definition here. And here are the entities that are considered excluded from the tax. So the most important probably to be aware of is that tax exempt 501c organizations are not subject to organ cap tax. That is for their exempt income only. So if you had a super large nonprofit that had over $750,000 of unrelated business income that was not part of their exempt income, then they actually would be subject to the CAT registration and possibly the tax. Not seeing any questions, please feel free to throw those in there if you have them. The other complexity to all of this was the guidance established this concept of unitary grouping, and it's relatively detailed. However, high level, it's just important to know that if you have overlap of ownership and centralized management, typically that you might have a unitary group. And if you have a unitary group, then all of the thresholds and the tax calculations happen for the unitary group as a whole, not for the individual entities. So if you think that you might have a case where you have the same owner that owns more than 50% of multiple entities, and it can be direct or indirect ownership, and you also have centralized management or centralized administrative functions or services, then you could have a unitary group and a unitary business. And so I suggest that you work with your CPA to analyze each of your potential unitary groupings and make sure you document that analysis. And like I said, that if you have a unitary group, it's per group that exclusion and registration requirement happens, not at an individual level. Alrighty. So let's move on to cost subtractions. So the actual tax is calculated based on your organ activity less these allowable cost subtractions. As you probably have figured out by now, because you've went through your tax season, that rental properties get very little, if any, cost subtractions. The general rule is it's the greater of 35% or of the greater of your cost of goods sold. Well, rentals don't have cost of goods sold because there's no goods that are produced, or taxpayers' labor costs. And it's really important to be aware of the definitions of labor costs because it's for specifically identified employees, which has to do with who files the tax returns for those employees. So if you have, typically what we see is if you have a partnership for your affordable housing, the partnership itself does not have any employees. They don't file any payroll tax returns. It's usually you're paying a management company who their employees are doing the work, or you're maybe the general partner, some of their employees are doing the work. So you don't get to deduct any of those wages because they're not an actual employee of the partnership. If you do have actual employees of the partnership, then you do get to have that cost subtraction. But what we've seen this last year is typically our rentals have had no cost subtractions, and so it's basically their entire gross receipts that are subject to the tax. Okay, once we figured out what all the things are and do they apply to us, then we actually have to calculate the tax itself. And so there's a 4-step process to calculate this tax. And we'll go through this process and go through a quick example as we wrap up today. So the first is to calculate your commercial activity ratio, which we'll discuss, and then determine if you have any cost subtraction, determine your taxable organ commercial activity, and then determine your potential tax liability. So the organ commercial activity ratio is really only in play if you have a case where you have some of your activity in organ and some of it outside of organ, which could be the case for large companies, of course, or if you have a unitary group that has businesses inside and outside of organ. So you take your organ commercial activity divided by all the other activity plus exclusions, and that's your commercial activity ratio. So if all your commercial activity is in organ for that tax filing entity, then your commercial activity ratio is 1. The next step is to determine your cost subtractions. As we mentioned, a lot of our partnerships we're working with don't have any cost subtractions, but if you have actual employees, then you might have a labor cost subtraction. So it's the commercial activity ratio times the labor cost times 35%. So then you take your commercial activity less your cost subtraction, and that is your taxable organ commercial activity. And you get to deduct a flat $1 million from that amount. So again, if you have $1 million, you have to file a tax return, but you might not pay tax because you're going to get that $1 million deduction. And then you take that amount times the tax rate, which is 0.57%. And then there's a flat plus $250. I'm not sure why they did that exactly, because you don't pay the $250. It's not a minimum tax. So it's only if you're actually filing the tax return, then that is your organ CAT liability. So just as a quick example, we're running out of time. So $1.5 million of rental income in a property located in Portland, Oregon, no other activity, and they do actually have employee wages and benefits of $250,000. So let's walk through what that would look like here. We would get to do a labor cost subtraction of $87,500. That ends up at $1.4 million of organ commercial activity that's subject to the tax. We get to deduct the $1 million, and that gets us $412,000 of actual taxable full amount, and that's times the tax rate plus that $250, and that's our actual organ cat liability. So you can see if you're over that $1 million, you're going to have to pay. It's going to be coming out of the partnership. Some partnerships, don't have a lot of cash flow, so be aware of that and plan accordingly. Make sure that you're registering. So if you're hitting that $750,000 threshold, you're required to register within 30 days of hitting that threshold. So if you haven't already registered last year and you have any partnerships that might be getting close to that, be aware of the registration requirement, because there is a penalty for failing to register. There's some good step-by-step instructions at the Oregon Department of Revenue online. Remind everybody payments are due at the initial due date of the return, which is April 15th. So even if you get an extension, you're supposed to make the payment. Otherwise, you'll have some penalties and interest assessed. If you will have more than $5,000 of CAT liability, you're supposed to make estimated payments. In order to reach that threshold, you have to have, I think it's like $1.8 million of Oregon commercial activity. That will get you to that $5,000 of tax. So keep that in mind as well. There is an ability to extend, but the extension does not extend the payment date. It only extends the tax filing date, and extensions are only supposed to be made if you have good cause. So just final words to wrap up. Make sure you analyze possible unitary groups. Make sure you consider how this tax, which applies to all Oregon commercial activity, might affect your costs of partnerships. So building costs for new partnerships, operating costs, improvement costs, repairs and maintenance, it definitely kind of increased the costs across the board for everybody.
Hey, Kari, we did have one question.
Yeah.
I think the question was the unitary rules applying to nonprofits. The question's in the chat, but I think for the most part, this doesn't apply to nonprofits.
Correct. So 501c tax exempt organizations are not subject to the Oregon CAT. So you don't have to worry about the unitary grouping for nonprofits specifically.
Looks like that answered the question.
Yeah.
I guess really quick, let's see. Well, go ahead. And we have a couple of things we could point out. And then of course we have left a little bit of time for questions if people have any questions. Well, while you're thinking, I did forget to point out one thing that come up a lot on the cost search this year is interest expense. So when you're doing your pro formas, your underwriting, and you're saying, I'm going to have this much in eligible interest expense, so interest before occupancy, what's happening often is people are not borrowing that money because they have money coming in first. They're not incurring the interest expense. So the good news is your interest expense is a lot less than you thought. The bad news is you thought that was going to be in your eligible basis, but it's not because you didn't actually spend it. So we've seen that come up quite a bit. The other thing was, if you're the nonprofit, if you're a developer, your developer, the person helping you develop the project isn't in charge of your accounting for the whole project. They're helping you do the accounting for the costs. We've seen a few times where the nonprofit's not really accounting for the entity, they're only accounting for the costs, and at the end of the year, they have a lot of problems doing their audit and tax return because they weren't really doing that yet. So just be aware of that. You should be doing your accounting during the year and reconciling the developer's cost reports into your own books. So
we could do definitely a whole hour just on cost certification. So those are a few little things. To that point, if you have other topic ideas, I know that Housing Oregon does their monthly or so meetings, and we're happy to speak on other accounting topics. If you have ideas, you can send those to Brian, and we're happy to present on something far longer than an hour if needed or more detailed. There's a question in here. Is there a concern if projects do not throw off amount of losses that were projected?
yeah, that's a good question. I guess that's between you and your limited partner. If you picture, let's say they put in $5 million, they're expecting to get losses to wipe all that out. If they don't, that I haven't seen people get penalized for that, but you could, because the two benefits they were supposed to get were credits and losses. So yes, I think it's a concern. I haven't seen a lot of them penalize people for the loss issue. They will penalize you for the credit deficiency. So that's something you want to discuss with them. Right.
I've also seen too, where maybe they stay longer in the partnership. So maybe if they were going to run out of basis year 12, they exit, but if they haven't, maybe they'll stay into year 13, 14, 15, where they wouldn't have otherwise stayed because they're still getting losses. Any other questions? Well, thank you everybody for attending our session, and please reach out to us individually if you want to discuss more or have any other questions.
All right, well, thank you everybody for attending, and thanks for our esteemed panel. I told you they were esteemed. Thanks so much for sharing your very detailed information, your vast experience, and your valuable time. We look forward to everybody having a pleasant day. And again, the materials, as our wonderful tech Dan put in the chat box, is available. We can stick around so you can copy and paste that as needed. Until we see you again, have a pleasant day.